Okay, boys and girls, let's get to work here. Setting up my stuff. All right, so we talked about this is the law of diminishing marginal returns, right? Diminishing marginal returns sets in only in the short run, right? And it's a short run phenomenon. It happens because one of the inputs is fixed, usually capital, right? So that's something you want to make a little note of. Diminishing marginal returns happens because the space gets too tight and then the workers start getting in each other's way. All right, and we'll probably do a little fun game in class about this. Maybe we'll do it before this. Maybe we won't. Who knows? We'll see. All right, so the next thing we're going to talk about is cost. All right, the payment that must be made to obtain and retain the services of a resource. That's what we mean by the cost. It's the payment that must be made to obtain and retain the services of a resource. What do you mean by a resource? I'll tell you what I mean by a resource. I mean land and natural resources, minerals. I mean labor, workers, capital, right? Human capital. We think of labor as human capital. Then we talk about regular capital, which is not money. It's the tools that go into producing goods and services, right? So we have those. Those are what I call, or what economists call, explicit cost. Production, the production, land, labor, capital, the cost of those are explicit. They cost you money. Okay? Then we're going to pause. We're going to take a little break here from all this economics, and we're going to go and talk about college. And how all of you are applying for college and all that fun stuff. And we're going to say, here's a college. $75,000 for tuition. That's an explicit cost. $75,000. That's the money you're going to come out of your pocket to pay for college. But we have, what about the implicit cost? See this? This is me working a hot dog stand. That's what I give up by coming to work every day. I give up the opportunity to run my own hot dog stand and make money. And I know what you're thinking. You see a ketchup bottle there. Yeah, there's a ketchup bottle because there's little hamburgers there on the side, okay? So you need ketchup. All right. I make $35,000 a year selling hot dogs. That's the implicit cost. Let's say that's you. I'm going to hire you to run that hot dog stand. I'm going to pay you $35,000 if you don't go to college. What's the cost of going to college then? It's the explicit and the implicit cost. Here you go. Right? We have these two. We add them up. And the cost of going to college is $110,000. Okay? You got to focus on the implicit cost. The opportunity cost of what you're giving up to go to college, or what the entrepreneur is giving up to run the business. So let's look at this. Here's the economic cost. All right, economists look at the money given up and the money coming out of your pocket. Implicit, explicit cost. That's what they look at, okay? Now, this is economic cost. These two. But the accountant doesn't think the same way. It doesn't think the same way. The accountant says, there's only this cost. This is it. What does it cost me for land, labor, capital? Right? I open up my own business and I say, yeah, my accountant calls me up and says, you made $75,000 this year in your business. And I go, great, but I could have made $100 if I stayed teaching. So what do I tell them? I tell them I lost $25,000. Right? Because the cost of opening this shop is the implicit and explicit, which comes to $100,000. The accountant goes, oh, no. It's only the cost of your land, capital, your labor, and things like that. Okay? So we're going to break this down a little bit. We have accounting profit, which is equal to revenue minus cost. So I want you to look at this. We have 4 slices of pizza. Okay, that's my revenue coming in. Right? I have to pay for the dough, the sauce, the cheese, the capital. Oh, look at that guy. Okay, that's my explicit cost. That's what the accountant is looking at. Okay, this is all he's looking at. He calls that a normal profit. Okay, that is an accountant. We're not an accounting class, boys and girls. We're in economics, so we're going to add one thing to this: the cost of the entrepreneur. All right, so you have your land, your labor, your capital, and then we throw in the implicit cost, the cost of the entrepreneur. All right, and going backwards, economic profit is accounting minus implicit cost. So you take your accounting profit, subtract what the entrepreneur would get. In my case, it was $75,000. Subtract that, and you are left with your economic profit, which in this scenario I gave you was negative $25,000. Okay. Go through it, right? Revenue minus explicit cost. Just to maybe give it to you a little, show it to you a little differently. Right, and then we'll give you one last visual on it. Okay, we have opportunity cost, and then what's left is the economic profit, and then the other side is just the accounting cost, the explicit. So economics is explicit and implicit, and the accountant is just explicit. Okay, so that's going to be part one of cost. So we'll just want you to kind of take that in, digest it a little bit, and then we will talk about it a little bit more, and then we'll finish up cost in one more video. All right, lads, lasses, have a good one.